Hey, good morning, everybody. Good morning. Sorry for the late start. I'm having some technical difficulties on my side. I'm trying to log into my Robinhood account. And I had to reset the password and all kinds of other funky stuff, but it still doesn't seem to be happening. We might just have to roll with it today and not have a portfolio update. But let me see if I can try to get me logged in here in just a second. Gonna try one last time, and if not, then we'll just roll with it. So hopefully this works, but I hope everyone's having a good day. I do know that there was, the Federal Reserve. They had their meeting today. I didn't look at the video. I didn't look at any actual material about the Federal Reserve because I want to kind of come to my own conclusions. So we're going to be looking at all of that today. We're going to be looking at a couple news pieces that came out that are just interesting, and then we'll just wrap it all up with a quick summary of the markets. Hopefully I can get this Robinhood account logged in, because if not, then we'll just have to kind of roll with it. But yeah, it doesn't look like it's happening. Let's see. Yeah, it doesn't look like it's going to happen, unfortunately, which is a total bummer. Because I even got kicked out of my Robinhood on my phone app, which again, also kind of a bummer. Dang, man, what's going on here? Technical difficulties, people. I am sorry about that. I am really, really sorry. I should be a lot more prepared before I start the stream. I don't know what happened. This seemed to just come out of left field, and yeah, we might just have to roll with it. All right, let me just try one last time. If this doesn't work, then we will we'll run with the show. All right, trying one last time here. Let's see. But I hope everyone is doing well today. I hope everyone's portfolio is doing well. I had some losses that I had to take because, again, I don't seem to learn my lesson, and I ended up holding on to a short position in SBIT a little too long when I should have cashed out. So again, this is the second time I've learned this lesson, and this is the second time I've taken a massive loss. So I'm hoping there's not going to be a third time, but we'll see. We will see. Right now, if you look at the Bitcoin chart, Bitcoin has been skyrocketing. So don't know if there's going to be, a massive dip again. The whole idea behind crypto winter is still there. So we'll see. All right, this is the last chance to get this working. If not, then I'm going to just have to move on with the show. Let's see. Yeah, come on. Two-factor authentication. Let's go. I guess it's not going to work today, guys. Yeah, that's a bummer. All right, no big deal. We'll just run with it. All right, we'll just run with it. All right, so let's get it started, guys. This is the portfolio update that we'll just go with. So this is what we're looking at right now. We're looking at annual net income, of course, still in the 50s, and March income is supposed to be about 4,500. I don't think it's going to be 4,500. Again, I'll do a video at the very end of the month, kind of summarizing how much dividend income I did make. All right, this is the portfolio values. We're going to have to just run with this. I don't think we'll be able to log into Robinhood. We should be able to log in M1 Finance and then check on the core portfolio. But again, there's nothing really all that sexy or exciting happening there. It's just kind of holding the core positions. So we have right now a $34,000 unrealized loss right now. So again, it's all because of the markets and what's happening. So nothing too exciting there. All right, guys. We will move on from this. I just wanted to add that I did add a couple new positions to the watch list, or companies to the watch list, I should say. I added Marvel, or Marvell Technology, not to be confused with, Marvel, the freaking, superhero comic book series or whatever, the creator of the comic book series. Marvell Technology. I keep seeing their name in the news. I know they're like a semiconductor producer of some sort, so I'm going to be taking a look at them along with Micron Technology. I know this list right here is obviously it's all tech heavy, but I want to see how each of these companies play into the AI thesis, and then hopefully, from all the research, I will have at the very end, some picks of my own. I'll probably go into either bull shares, 2x bull shares or something, or maybe cover call ETFs for some of these. Again, all that is left up in the air. I still have to do my due diligence. I am still long in pltw, which is a 1.2x levered or 1.2x levered position on Palantir. So I'm going to hold that until, either Palantir recovers in share price, and then I'll sell at a profit, at a pretty decent profit, I hope. Meanwhile, I'll still be able to collect income. So the idea is, find these ones, find the momentum players, the ones that actually, should go up in value, that have, a lot of likes behind them or under them, or they might even be at a discounted price, and then invest not into the stock, but invest either into a leveraged position, either using bull shares, 2x leverage, or, maybe a 1.2x levered ETF with, some type of income mechanism, or just investing strictly in a cover call ETF version of these, right? Because there are several of them. There are some for AMD, there's some for smci, there's some for nvda, definitely some for Palantir, right? I don't know about these other guys, so again, I still have to look into that stuff myself. So let's move on real fast. We're going to cover real quick just some news articles, and then we'll roll right into the Federal Reserve speak. All right. So NVIDIA XAI joined global AI infrastructure group to develop data centers. You guys know what a data center is, I'm sure. If not, basically a data center is a piece of real estate with a bunch of buildings. They have like HVAC systems, a lot of wiring done. And basically this is where all of the computers, all the servers live, right? That have and store data that are used to basically transmit data, between locations. So whenever you're viewing, something on your phone, like a YouTube video or something, what's going to happen is you're going to hit a cell tower of some sort. That cell tower is going to transfer that data through the fiber, and it's going to hit a data center. That data center is, where YouTube has all of its servers, and that's where it serves up the video, right? And then within that data center, you're going to have the servers, you're going to have the semiconductors, you're going to have the chips, you're going to have the hardware, you're going to have all that stuff on top of that. So this is interesting. This is very interesting that NVIDIA is actually, a part of a deal like this, because again, they're rolling out their chips. They're trying to roll out their chips and their hardware to everywhere. And, I'm really interested in NVIDIA. I know there's a lot of talk out there that, it's still overpriced. It's at all-time highs. This correction was good for NVIDIA, but, I still want to do a little more due diligence into NVIDIA and see if there's something there, something I like, because honestly, I'm really considering doing some type of, levered position on NVIDIA. I don't want to invest directly into NVIDIA because I just don't. It is still a very expensive stock, and I don't want to hold it for the long term. I just want to hold it, let it recover its price, make some money, and then make some dividend income on the way up. All right, so anyways, let's take a look at this real fast. NVIDIA and XAI, which is led by Tesla, CEO Elon Musk, are the latest companies to join the AI Infrastructure Partnership, a new initiative launched in September that invests in data centers for artificial intelligence around the globe and the energy needed to power them. NVIDIA and XAI join BlackRock, all right, Microsoft, and MGX in the endeavor. If you guys don't know who BlackRock is, because we all know who Microsoft is, I don't even know who MGX is. That's someone I'll have to take a look into. But BlackRock is the biggest player in the asset management space. They have like some couple $1 trillion worth of assets under management. So they are a big player. They actually just partnered up with another couple of private institutions or equity, and they actually purchased the ports at the Panama Canal. So right now, BlackRock owns, basically the whole Panama Canal, which is very interesting. The United States basically pressured, I wouldn't say pressured, but they were, the United States was upset to find out that the Panama Canal was owned by a Chinese company, specifically a company out of Hong Kong. So once that was discovered and that was found out, because it is such a key port and it is such a key location, especially when it comes to national security and shipping and economy, they wanted to basically, and when I say the United States basically wanted to take control of the Panama Canal, and they did so through BlackRock. BlackRock led the initiative with another couple of companies, private equity institutions, and they purchased the Panama Canal. So that Panama Canal is back under United States control in one way, shape, or form. Anyways, the partnership seeks to initially unlock $30 billion in capital from investors, asset owners, and corporations, and then mobilize up to $100 billion in assets. I'm trying to read today. $100 billion in total investment potential when including debt financing, the group said in an announcement today. The global build-out of AI infrastructure will benefit every company and country that wants to achieve economic growth and unlock solutions to the world's greatest challenges, said NVIDIA CEO Jensen Huang. AI factories built on NVIDIA's full-stack AI infrastructure will convert data into intelligence that will accelerate every industry and help society achieve unimaginable breakthroughs. This is a lot of hype, all right? A lot of hype, a lot of word salad going on. AI has the potential to transform the global economy if we can build the necessary infrastructure to support it. That is true, added BlackRock CEO Larry Fink. We believe this unparalleled partnership of leading global companies across AI ecosystems brings technology expertise together with private capital to meet this demand and create unique investment opportunities for our clients. So again, whenever, and I've said this in previous streams, whenever BlackRock, says something, it's worth listening to. And if they're going to be adding money into this whole AI, thesis, I don't think AI is done, right? I really still think that we just scratched the surface and we have years and years and years of continued growth for stocks that are, directly involved in AI, in artificial intelligence, that are going to be involved in the build out of the infrastructure. Again, we covered on the stream the Stargate project, which is a partnership between SoftBank, based out of South Korea, SoftBank, NVIDIA, and OpenAI, and Microsoft. And basically, this is going to be a $500 billion investment into building out AI infrastructure. So for BlackRock and NVIDIA to come out and, say, hey, we're going to also put in another $100 billion on top of Apple's already committed, another $100 billion? I mean, good God, there's just so much money being sunk into artificial intelligence, the infrastructure to support artificial intelligence, and, basically continued research and development. So this is a very exciting time. This market correction, again, could be viewed as something very scary, could be viewed as something, to just keep investors away, to sell out and move their money into safer assets, or this could be a very prime opportunity for a lot of people who want to take advantage of cheaper shares for great companies. All right, so moving on, this is just something I found. Again, I think like under $1,000 in Ripple, and I just bought it just because it was a FOMO play. But XRP token spikes after Ripple's Garling House says SEC will drop the crypto lawsuit. The cryptocurrency tied to blockchain payments firm Ripple Labs gapped up 14% in Wednesday late morning trading after Ripple CEO Brad Garlinghouse said the U.S. Securities and Exchange Commission, the SEC, will abandon its long-running lawsuit against the company. In 2020, the SEC sued Ripple, claiming that XRP was an unregistered security, but Ripple argued XRP is a digital currency, not a security, falling out of the SEC's regulatory purview. The diverging views led to a year-long legal court battle. The court ruled in 2023 that sales to retail investors through exchanges did not violate securities law. Though Ripple's institutional sales broke security laws, resulting in a $125 million fine, the SEC appealed the court ruling in 2024. So this is finally dropped. Like I mentioned before, in my own opinion, XRP had probably the best utility case over a lot of the coins out there, a lot of the crap coins and altcoins and all that meme coins and all that other crap out there. XRP, I think, still has the best utility because, again, its whole goal is to get rid of ACH, get rid of Swift, right? That is basically what it's trying to do, unless it's changed. It's been a while since I looked at it, but it's basically trying to make transfers internationally between banks, instantaneous, right? Versus ACH, where you need to wait 3 to 5 business days, or a wire that could take, some time, especially if you're transferring money internationally, that takes time as well. So having XRP and their whole, and again, I'm going to butcher all of this, but their whole Hyperledger and, all that other stuff, that is groundbreaking groundbreaking technology. Man, I cannot speak today. I'm sorry, guys. Like, I am all messed up today. I started late, having trouble with my Robinhood account. Man, I apologize. I am not doing well right now. Okay, let's try to get back on track here. All right, fear and greed index. We're up a couple points. We were at 18, and now we're up at 22. So we're getting a little out of the fear. Hopefully, we'll just move into fear and not stay in extreme fear. Again, if you're an opportunist, this could be a great time to be investing in the stock market, whether you're buying an S&P 500 index or, index funds or whatever, or, purchasing some, of these bigger technology players, the Magnificent Seven, whoever. Again, I have my own opinions about the Magnificent Seven, but again, maybe they may not be bad plays. You have Meta that I think year to date, they only lost a couple percentage points. They aren't down that bad. As a matter of fact, let's check since I'm talking about it. So we're going to just take a quick look at Meta and just see how their stock price is doing. Because I saw a post last night, I didn't check it at the time, that they're only down a couple percentage points year to date. Yeah, look at that. They're only year to date, they're only down 3%, right? Or 2.5%. If we look at nvda, they have been crushed. They've been crushed 15%. If we look at, let's see, Apple. Let's see how Apple's doing. Yeah, 11%. So I'm actually really surprised Meta has not lost that much in value. But again, all these other bigger players, Apple, Microsoft, Google, Tesla, maybe, I don't know, maybe Tesla. These might be opportune times to pick up some shares on the cheap if you like the company. All right, if you like the company, I got to put that disclaimer out there. All right, now we're going to move into the biggest part of this stream. This is probably going to be the biggest one because we're going to cover this minute for minute. And again, I didn't even watch this yet, so I don't even know what to expect. I tried not to read any articles or watch any videos about this because I want to formulate my own opinions. So we're going to look at this and just go through it. I just know he spoke, and I just know that the markets are green, right? So I want to know exactly why. So here we go, guys. If you haven't watched this, strap in, and I'm just going to kind of explain my own thoughts along the way. If I can get this, and then we will hit play. Skip ahead. There we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged.
All right, so leaving the rate unchanged, the federal funds rate, the interest rate, right? So we're staying at 4.25% to 4.5%. So this was expected. I don't think this was unexpected by anybody. It's been mentioned several times, even by Jerome Powell, that they're going to take a wait and see approach. So this was, I'm not going to say it's welcome news, but it's not exactly a surprise either.
We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid.
All right, so that's a little bit of worry right there. So basically, Jerome Powell saying that we expect lower GDP, okay, lower GDP, which is not a good thing. Lower GDP basically means the United States is not producing a whole lot, right? It's the gross domestic product, so that's not good. That's definitely not good. And then he's also mentioning that, in the second half of 2024, there was a lot of consumer spending, a lot of positive sentiment from the market. And now it looks like it's starting to retreat, probably because of all the tariff talks and all the tariff being put in place and things becoming expensive, right? So we'll just continue.
Solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery.
So that's good. That's still very good news. Unemployment's at 4%. And I hate to use this word, but it's healthy, I guess, for an economy to have around 4% unemployment. It's nothing detrimental. Anything lower than 4% is obviously very good, because it's maximum employment. But once you start getting into that 90s range, that low 95 range, that's when things start to really get spicy. Again, 2008, 2009, there was like a 10% unemployment rate, and I think as high as 15 for the pandemic, the CV-19. When that happened, the unemployment was obviously very, very high. But, there was a bounce back, a quick bounce back because of, remote working and Zoom stock taking off and all these, teleconferencing technologies coming out. So, yeah.
Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%.
So he's saying that inflation is up. So inflation is up. So again, that's not a good thing either. And that's obviously why we're keeping the federal funds rate at where it's at.
Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures. And survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December.
All right. This is also very key. The Federal Reserve is expecting that inflation is not going to reach their 2% goal over this year and definitely into next year. So again, sticky inflation, right? We've heard this term before. We've used it or heard it 100 times that inflation is very sticky. If the Federal Reserve is projecting that inflation is still going to be above their 2% goal, then, we can probably surmise from that the interest rate, the federal funds rate, will probably stay at least a little elevated throughout this duration, right?
In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high.
So now uncertainty. Now the Fed is uncertain about how these tariffs are going to impact the economy. All right. He hasn't really changed his tone on this. He has said that in the past, but he also, Jerome Powell has also said that tariffs typically don't impact the economy long term or drive inflation higher based on historical data. So here we are right now in the present, hearing him say that tariffs are definitely going to impact the future. So this is, again, you just always got to stay ahead of this stuff. You got to always hear what they're saying.
As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC.
So just real quick, again, the Federal Reserve is taking a wait and see approach to how these tariffs are going to impact the economy. So there's no rush to either lower interest rates or, again, there's always the small but not zero chance that they could also increase, the interest rate. But again, that is not the case right now. He always keeps talking about, just maintaining a steady pace, seeing what data comes out. He mentioned in his last remarks that the Federal Reserve is not going to act just because of one or two bad reports, right? And that's over a span of a month, 2 months or so. So they're waiting to see the impact, and we still have to wait for April 2nd when the tariff bombs start dropping. So I think April, May's timeframe when the Federal Reserve meets again and they have another public conference like this, I think that is when we'll really know what's going to happen.
Participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty.
Yep.
The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at
Ooh, you heard that?
the end of next year.
So 3.9% is the expectation for this year, and then lower than that next year. So that's exciting. That's at least good. Again, they're projecting that can change, but it's still good to at least put a goalpost somewhere.
Unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
All right, so nothing really changed here. No changes for at least a short term. Again, what I'm taking away from all this is that they're still going to take a wait and see approach. We're still waiting to see how the tariffs are going to impact, the United States as well as the global economy and what's going to happen there. Interest rates, hearing what the goalpost is actually kind of nice. At least we have a direction. So by December, at least they're expecting by December will be around the 3.9%, which is awesome. Past that, much lower. So that is really, really good to hear. Of course, it's fluid. Everything is subject to change. It really depends on how these next couple of months are playing out. And a big part of that is, again, and I hate to keep beating the dead horse, but a big part of that is going to have to do with the tariffs being put in place. Inflation, again, I think that's kind of subsided, the whole notion of inflation, just being the boogeyman. I think that's really subsided quite a bit. Inflation is going to come down. I think inflation is going to come down. They're projecting that inflation is going to be sticky. And I mean, they have all the, analysts and all the fancy formulas and all that to figure that out. But I think the market itself is kind of moving into this new normalization. And I spoke about this before, that this, the market is just accepting that inflation is going to be at this rate, right? Scott Bessent, Secretary of Treasury, said, it's, the American dream is not cheaper products. It's not cheap products, right? And I think that's going to play true. I think that's going to be absolutely true over these next, this next year or so, as we continue to battle inflation. So I want to keep going. I don't want to stop here because I want to hear what the reporters have to say. So I'm going to try to speed it up and just get a couple points here and there. And then we'll move into kind of the rest of the segment. I don't think there's going to be a portfolio update because I can't log into Robinhood right now. But we'll continue with it and kind of rock with it. Again, I'm going to stop the stream around the 1 hour mark. So around 10 o'clock Eastern Standard or 9 a.m. my time. So we'll just run with this.
Howard Schneider with Reuters. Thanks for your time. So two things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
So that's a good question. That's a really good question.
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case. But as I
we're back to transitory. Oh, come on, man! Don't even use that word.
I said we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there's a level of inertia where you just say, maybe I'll stay where I am.
See, again, a wait and see approach. He just mentioned it. I hope I don't kill this. I want to hear that again.
Changing something in this highly uncertain environment, I think there's a level of inertia where you just say, maybe I'll stay where I am.
Maybe it's right here.
There wasn't much change. I think that's partly because you see weaker growth but higher inflation.
Weaker growth, higher inflation. So weaker growth, higher inflation. So they're stuck right in the middle because they want more growth, right? And they want lower inflation, and they're stuck right in the middle. So now the Fed has to take this wait and see approach. That's
kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there's a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations. And people who fill out surveys and answer, questionnaires are pointing to tariffs about that. If you look,
but on the deterioration in consumer confidence surveys, you said recently that this is perhaps not the best indication of future spending. But I'm curious, what you think is behind this deterioration, and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response.
So economy is doing well. Economy is healthy, but inflation is still there. Inflation is still a problem.
To tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risk. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy is in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability?
Don't even know what the question is. Can't even
You
hear
see
him.
buy in advance psychology, big changes in inventories, and
All right,
five.
skip that.
So
With Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
yeah, so
Don't care.
very unexpected. I think significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case.
So transitory is the base case. So basically the tariffs are implemented, prices go up, but it only for a limited time only. So this is what they're calling transitory increases in prices. I hate that word transitory. I don't hate the word, but Jerome Powell, he got his butt slapped for calling inflation transitory when basically after CV19 occurred. So he was saying that inflation was only transitory. It's only going to be around for a little bit. We're going to get right through this, and inflation is going to come down. And then we saw massive amounts of inflation. We saw as high as 10%. So I think he has that scar, and I think people when they hear that word transitory now, they kind of just laugh about it. They laugh. I don't know. I laugh at Jerome Powell every time I hear him say it.
Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time?
There we go.
And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
Pandemic, yes. During the
Because you could have been
There we
talking about
go.
the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. It's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And
I'm just gonna skip
so
that one.
has moved up.
Particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it. We don't dismiss data that we don't like. We force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based.
Yeah, so basically there's this Michigan report that came out of Michigan. I didn't even read it, to be honest. I saw the headline. I didn't read it. But, this was because it reversed, I think, twice in the same day, or they kept updating it, and I was like, I'm not going to read it. But basically this report came out and showed that there was a weakening in sentiment, a weakening in consumer sentiment, and that for that day that drove the stock market to go down, because it was like basically consumers are not spending any money, at least if I recall correctly.
Assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Thank you.
It's hard to say when that will be. Sentiment data and high uncertainty to the best we can. And of course, we're going to try to be timely with that. For right now,
skip.
Able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. Going to be very, very a big piece of it. I think we'll know in a couple.
All right, guys. Yeah, I'll have to come back and look at these questions, these reporter questions, because they do ask some really good ones. So a lot of them are kind of just pundit type questions. They try to pigeonhole him into something to try to get him to say, to say really negative, news and basically create this narrative. So, some of the reporter questions are kind of just silly, but there are some good questions in there, but I'll have to review this at a later time. So yeah, this is basically what Jerome Powell said. Basically my takeaway is nothing really changed. Federal Reserve is going to maintain their rates easily until, May, June timeframe. Again, the tariffs are creating a lot of FUD, fear, uncertainty, and doubt. We won't know what the true tariffs are going to be until about April 2nd, because that's when Donald Trump has mentioned, and his cabinet has mentioned, that April 2nd is going to be the date. So again, unless we hear news from now until then, good or bad, we can only assume that April 2nd is going to be an Armageddon of tariffs. So when that happens, very likely the markets are going to take a nosedive. Very likely the markets will take a nosedive. And I think once we get through this, what they call a tariff tantrum, which you guys have probably heard in, back in 2022 or ish, around that time frame, maybe it was sooner than that. Maybe it was like 2020, 2021. There's this whole idea of the tariff tampers or tantrums. Basically the stock market was reacting to all that negative news. And then it later climbed up, right? So maybe we'll see something similar in April. So anyways, we're just going to continue on with the stream, guys. I will have to come back to this later. S&P 500, we are up 1%, full percent for the day, which is a really good sign, because anytime the S&P moves up or down 1%, you could tell it's going to be a very green day or a very bloody day. Man, I cannot speak today. I don't know if I got enough sleep or something. All right, for the NASDAQ 100, we are up 1%. And 30 basis points. So we're doing well here. Technology is obviously rebounded. For Bitcoin, this is my biggest pain right here. So it dropped down twice to 81,000, right? Or close to $81,000. And I I had a short on Bitcoin, and of course I got destroyed. So I ended up selling out of Bitcoin at a huge loss. And again, it's my fault. I keep holding these short ETFs overnight when I shouldn't. And I don't know what caused Bitcoin to rise. I haven't found anything concrete. Of course, there's, it's just based on market sentiment or investor sentiment, whatever you want to call it. But this had a huge rise yesterday or today. So I'm going to keep monitoring it. I wish I got in on some bull shares, but I guess not this time. So maybe next time. Gold is still the best performing asset year to date, which we already knew. It's up 14.5% for the U.S. Treasuries. It actually went down a little bit, which is nice. Still not as down as it was a couple of days ago or about a month ago, if I recall correctly. Yeah, we were down at one point in early March to 4.2%, which was really nice, and as low as 4.18%. So hopefully we get this again. This is a good gauge to see how mortgage rates are doing and, how real estate, debt markets are doing. And we use this to kind of gauge how REITs are doing. So there is a saying out there, you guys heard me say it before, but whenever there are rates down, REITs are up. And then whenever rates are up, REITs are down. So that holds true today. So we're doing good and excellent there. So that will pretty much do it for this stream, guys. I don't know what is going on with my Robinhood account, but we can't really do a deep dive in there. The only change I made was exiting out of my SBIT position because I was taking way too much losses there, and I seem not to learn the lesson. And the lesson is don't hold short ETFs overnight. That is pretty much the lesson I'm going with. I'm going to make sure I never make that mistake again. My total loss, I think, because I exited twice, and twice I exited at a loss. So I think my entire loss altogether is about $1,500. So that's obviously really shitty, but it's one of those lessons you just have to learn. You could paper trade all you want, but going through the pain and actual loss is really going to kind of help you understand this a lot better. So I'm definitely going to make sure I never hold it again, and I'm going to profit rip once it reaches $400 or $500, because I reached $400 and $500 around here. But I got greedy, and I was like, I'm going to keep it until it goes down to 77 or 75,000 or 70,000. And I kept getting these big numbers in my head. And then of course I paid the price, which is a total loss, right? Well, not a total loss, but a loss of about $1,000. So is what it is. It's just one of those lessons, again, you have to learn. And hopefully I learned my lesson this time. So there will not be a third time. If I do enter or re-enter a short position, if I reach $400, cash out, or $500, cash out, and do not hold these ETFs overnight. So that will do it for this stream, guys. I have to get going. I have a full day ahead of me. I have a bunch of friends who are visiting from overseas who are in the country, so I got to head out to Bangkok to go out and meet them. But I hope you guys got some value from this stream. I hope you guys enjoyed this stream. Looking at our survey real quick, at our poll, I asked the question, will stocks only go up from here after the Federal Reserve spoke? And 57% of you voted yes, and 43% of you voted no. So we will see. All right, this will be interesting. Definitely, if you're considering long positions, be safe, be careful, because those could backfire in a minute, especially when it comes to cryptocurrencies. So other than that, I appreciate you guys joining. You guys have a great rest of your night or evening or wherever you're at in the world, and I will see you guys